Hi, my name is Kanyi. I'm a senior associate in the tax controversy and dispute resolution team here at PwC. I will be discussing tax avoidance and the consequences as provided for under Kenyan tax law. Tax avoidance is a topic that has attracted attention globally. It has been the subject of intense public discussion. Tax avoidance strategies, especially by multinationals, have attracted global efforts in the form of the OECD BEPS project, which seeks to close gaps in international tax rules. What constitutes tax avoidance is very subjective, and it has been defined according to evolving attitudes. In Kenya, Section 2 of the Tax Procedures Act defines tax avoidance as a transaction or a scheme designed to avoid liability to pay tax under a tax law. The essence of this definition is that a transaction or a scheme has been entered into to avoid paying tax that would have otherwise been payable if it were not for the transaction or the scheme. Tax avoidance is subject to great public debate due to its contribution to the tax gap, which is the difference between what the Kenya Revenue Authority collects as revenue and what they believe they should be collecting. In this regard, under the law, there are certain mechanisms that the Kenya Revenue Authority can employ to deter and counteract tax avoidance. In the context of income tax, Section 23 of the Income Tax Act empowers the Commissioner to make adjustments to a taxpayer's liability to counteract avoidance, where the Commissioner is of the opinion that the main purpose or one of the main purposes of a transaction entered into is to avoid tax. In Kenya, there's no judicial exposition or guidance on what the main purpose or one of the main purposes of a transaction means. Where the Commissioner is of the opinion that a taxpayer has engaged in tax avoidance as described in Section 23 of the Income Tax Act, the Commissioner may adjust the taxpayer's liability, resulting in an amended assessment. Apart from the amended assessment, the Commissioner may also levy penalties for tax avoidance. Under Section 85 of the Tax Procedures Act, the Commissioner may levy a penalty equal to double the amount of tax that would have been avoided, where the Commissioner applies a provision to counteract the tax avoidance.
Following the discussion by my colleague Kanyi on the issue of tax evasion, a very interesting court decision came out recently whereby a leading supermarket took the Revenue Authority to court and challenged them where they had accused them of tax evasion. The court made very clear pronouncements on its interpretation of the word tax evasion and made it very clear that there's a difference between tax evasion and whereby a taxpayer arranges its affairs in a manner that will make it not tax liable within the limits of the law. Tax exemptions and tax reliefs cannot be equated to the same thing as aggressive tax avoidance. The High Court relied on a UK decision whereby the key elements of tax avoidance were defined to be a preordained series of transactions with no commercial purpose, with the sole purpose of tax avoidance. Because the terms tax evasion and tax avoidance can be interpreted subjectively, depending on the ultimate results that either the taxpayer or the authority would want to get, it's very important for a taxpayer to keep their records correctly because the penalties are quite punitive, especially in the current business environment.